Anyone can Google, should I roll over my 401k into my IRA? And if you go ahead and research this, you're going to see a list of reasons on both sides, reasons to roll over and reasons to not roll over. But unfortunately, these reasons often aren't compelling enough to make a very clear case whether it's best for your situation. Well, in this video today, I'm going to talk about 6 unexpected reasons you're going to want to perform a rollover from your 401k to your IRA. I'll also talk about an important consideration you need to think about in this rollover process. Let's get into it. Now, on the screen, I have consolidated a list of the often discussed reasons you may want to consider a rollover or not consider a rollover. And the problem here is, depending on your situation, these reasons might not be compelling enough. For instance, if we look at the reasons you do want to perform that 401k to IRA rollover, the biggest reason is flexibility. When you're invested in a 401k, you have a set menu of investment options. Whereas if you rolled that into an IRA, you have essentially unlimited investment options to choose from. But if you're invested in low-cost index funds inside of that 401k and you plan to do the same outside of that 401k, well, that's not really that compelling of a reason. Now, as we go down the list, there are some other reasons, such as consolidation of assets, moving all of those tax-deferred accounts into one account. But really, depending on your situation, this isn't incredibly compelling. Now, on the flip side, reasons you may not want to roll over your 401k, the biggest is the ability to withdraw at younger ages. So if you're retiring prior to 59 and a half, 401ks allow you to use the rule of 55, meaning that if you qualify, you can take from your 401k as soon as age 55. For public employees, this might be as soon as age 50. But once we go beyond that, the level of importance for these additional reasons falls, in my opinion. For instance, creditor protection and a loss of a 401k loan. For some retirees, that is very important. But for the vast majority of retirees, that is at most an ancillary benefit. And so let's set these reasons aside. These are talked about ad nauseum, and you certainly don't need another YouTube video that just repeats what a million other YouTube videos repeat. Let's talk about 6 reasons that aren't discussed. The first, in my opinion, is one of the biggest. And this is with withdrawal or rebalancing constraints. And so this varies in every 401k, but is an important reason when you get into retirement that you may want to move money out of that 401k. So let's say that we take a hypothetical 401k allocation where we have 10% invested in a stable value fund, we have 25% invested in bonds, and 65% invested in stocks. Now, the problem here is when you're in retirement, you generally want to use that 401k for income. Well, the problem here is most 401ks have rebalancing and withdrawal constraints. So generally, depending on the market environment, we may want to take from specific investments while allowing other investments to continue to grow or recover. For instance, here in 2022, with the stock market down pretty substantially, we may want to be looking to take from stable value funds or maybe even bonds and allow our stocks to recover so we're not withdrawing and furthering that loss. Well, the problem here with a 401k is generally you have to take out pro rata from each of these allocations. So let's say that you need $100,000 of income in retirement. Well, you'll have to take $10,000 from stable value, $25,000 from bonds, and $65,000 from stocks. Well, this can be a big problem, especially in a down market, because now we're taking the majority from stocks that are already at a decline. Now, there is a fix for this situation. For instance, you can take pro rata and simply rebalance afterwards. For instance, in this situation, if you wanted to take all from that stable value fund, you can withdraw based on the pro rata rules and simply rebalance afterwards, moving $25,000 and $65,000 from that stable value fund into the other investment accounts. Again, the problem here is, though, rebalancing constraints. Oftentimes, 401ks have mandates where you can't rebalance on a regular basis. They typically have 30 or 60 or 90-day holds where you can't adjust your investments once again until you've passed that 30, 60, or 90-day hold. And this leaves a retiree with just a lack of options, and a lack of options typically means we're not getting the most out of our situation. Now, reason number 2 is one that doesn't have as big of an impact as reason number 1. But one I included because it bugs me, and I'm guessing would bug a lot of you as well. And here's why. 401ks have a mandate underneath ERISA laws. And this mandate specifies that if you take a distribution from a 401k, you have a mandatory 20% withholding. Well, depending on your situation, that might be way over withholding. And if you're over withholding, you're giving the government an interest-free loan. For instance, let's take a retiree that needs to live on $75,000 worth of income, and they're both 65 years old. And so if they were going to take $75,000 from their 401k, they would be mandated to withhold $15,000. But the problem here from a federal income tax standpoint is their tax liability at the end of the year is only going to be $5,145. So they've essentially withheld more than $10,000 than they need. Now they will get that refund come tax time the following year, but they just gave the government an interest-free loan during that time. Reason number 3 is RMD complexity. And this is very important because the RMD penalty, the penalty for missing your RMD, is a 50% penalty. And so it's very important that we take the right RMDs when we need to take those RMDs. Well, here's the problem that's created due to RMD aggregation rules. RMD aggregation rules specify that if you have money in IRAs and 401ks separately, you have to take RMDs separately from those two accounts. So for instance, let's look at a situation where John has a 401k and he's mandated to take a $37,400 RMD. The IRAs they have with their current advisor are $21,000. And then Beth has a 403b that they need to take a $16,800 RMD from. Now, this couple might be thinking, let's just take all of our RMDs, our required minimum distributions, from our IRAs. That way, our advisor can coordinate those given RMDs and we don't really have to worry about that. But the problem is if they go ahead and do that, they will have some pretty significant penalties, all things considered. For instance, they would have an $18,700 tax penalty from John's 401k and an $8,400 tax penalty from Beth's 403b. And the reason being is because they have to take RMDs from each given account specifically. Now they can consolidate together their IRAs and take one RMD from their IRAs, but with company plans, they have to take a separate RMD from each of those accounts. Now this leads to 3 separate distributions rather than one, and just leads to more complexity. More complexity means an increased likelihood of making a mistake, and mistakes cost you money. Reason number 4 is there is no ability to take qualified charitable distributions from your 401k. Now, there are a number of you watching this video that are charitable minded and are going to have required minimum distributions that are up and above your income need, meaning that they are an excess RMD that you ultimately don't need. Well, one of the most beneficial charitable planning strategies is using this QCD. And the reason it's powerful is with a QCD, it's what's called an above the line deduction, meaning that you don't need to itemize your deductions and include this QCD. It's in excess of your standard deduction or itemized deductions. Basically what you're able to do is take your RMD and simply gift that to a qualified 501c3. It completely eliminates from your tax situation and allows you to remove that tax hurdle altogether. Reason number 5 is estate planning complexity. So 401ks, because they are mandated by ERISA laws, are a little bit more complex from an estate planning standpoint. So let's take a situation where Janet has a 401k. Now, Janet ultimately wants to make her children the beneficiary. Janet is on her second marriage, and with this second marriage, they've decided to keep assets separate and make sure those assets go to their specified children. Now, the problem here with Janet's 401k is she does have her children as the primary beneficiary, but this is only valid if she took certain precautions ahead of time. For instance, due to ERISA laws, spouses have the primary and default beneficiary status. And so Janet needs Tom to sign off and sign consent to approve an update in the primary beneficiary. If she doesn't do that, then by default, Tom will have first right of refusal, if you will, on Janet's 401k when she passes away, and those primary beneficiaries will not be fulfilled. If you're in this specific situation, you want to make sure that you take the right steps to make sure your beneficiary plan is fulfilled. Now, something that Janet can do if Tom does not sign off on that consent is Janet does not need consent in order to roll her 401k into her IRA. IRAs also don't have any consent that is needed. And so Janet could make that rollover into that IRA and then make her children the primary beneficiary on that IRA. And then finally, reason number 6 is one that may apply to you or may not apply to you. Some 401ks do not allow in-plan Roth conversions. And as you've seen from our YouTube channel, we are big proponents of Roth conversions, and it's a vital part of an efficient tax planning strategy for so many retirees right now. Well, if you have the majority of your tax-deferred accounts locked up in your 401k, and those 401ks don't allow Roth conversions, you may want to roll out just for that specific strategy. Now, after seeing these 6 reasons, before you go ahead and roll over your 401k to your IRA, understand that there's one more hurdle we need to overcome. And this hurdle is a logistical one. Now, when you're transferring most accounts, it's quite simple. Let's say that you're making an IRA transfer from Fidelity to Charles Schwab. Well, you can transfer what's called in kind, meaning that the investments you hold within the IRA at Fidelity are going to be the same investments you hold in the IRA at Charles Schwab. You hold those through the transfer, so there's no performance that you missed out on. But the problem with a 401k is there is no in-kind rollover. You generally have to do a cash transfer, meaning trade the investments to cash, transfer the cash, and then reinvest inside of your IRA, wherever that IRA is. Well, the problem with this, especially in a volatile market, is you may miss out on quite a bit of performance during that transfer window. Now, if that performance is negative, that's not the end of the world. But if that performance is positive as the market's recovering, you may miss out on some important growth. But I have some solutions for you to overcome or at least lessen the impact of this hurdle. The first solution is doing a 401k rollover to an IRA at the same custodian. And so let's say that you have a Fidelity 401k, we'll open a Fidelity IRA. That rollover at the same custodian generally happens as fast as it can because there is no mailing of any check, there is no extra transferring. And so once it's in that Fidelity IRA, then you can transfer in kind and avoid any performance lag from transferring to another custodian. Solution number 2 is essentially dollar cost average your rollovers. So if you have $1 million account, maybe do $200,000 rollovers and do 5 of them in order to get them to their IRA. This can be a nice way to transfer out our risk over a couple different rollovers. Number 3 is rebalance from safety in your IRAs and outside portfolio. Well, what do I mean here? Well, let's say that you have $1 million 401k and you have $1 million of traditional IRAs, Roth IRAs, and a taxable account on the outside. Well, we know that the allocation within our 401k has to be traded to cash and then that transfer has to happen. Well, what we can do is we can take the most volatile assets, such as stocks, that might change quite a bit during that short-term transfer period. And we can simply add in stocks to our other portfolio. So let's say that we are holding some cash or safer investments in our outside portfolio. Well, we can sell out of those safe investments, buy extra stock in order to offset the stocks we are missing out on during that 401k transfer. Remember that 401k transfer is going to happen in cash. And so you have a huge safe allocation during that short-term period. And so if we rebalance back into stocks, a higher stock allocation in our outside accounts, we can overcome the volatility that we'd be missing out on during that transfer window. Now, finally, the number 4 solution is one that I just think everyone should automatically be doing, and that's overnighting the transfer check. Now, typically 401ks will charge you $10 or $20 to overnight that check, but this is a drop in the bucket when you think about it. If you're transferring $1 million 401k over and it gets there a couple days sooner because you overnighted the check, well, those few extra days should more than make up for the cost of that check. And so there you have it. The majority of you will want to do a 401k to IRA rollover before you get too far into retirement for the exact reasons I talked about in this video. But what is advice for most of you does not mean it is advice for all of you. Now, for some of you, rather than doing a rollover, you may want to do what's called a reverse rollover. Now, what would be the reasons you'd want to do a reverse rollover? Well, we talk about those reasons in this video right here. Click on it to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching. We would love to hear any feedback that you have in the comments below.